today I want to talk to you about another tool that you can use in your business that is very helpful for you to understand how much money, how much cash, how much assets, how much liability, basically an overall snapshot of what you have. Hey, badass business owners, my name is Tammy, and I'm here to help you grow your business and, more importantly, make more profit. And we make more profit when we understand our business numbers. So today we're going to take a few minutes and we're going to go through what's called a balance sheet. Now, you probably have heard of a balance sheet, but you may not have a clue as to what it is. For some of you, if you have a CPA or an accountant who does your books for you, they've probably given you a packet full of papers or emailed them over to you or gave you a link. And inside of that is this one form that says balance sheet, and you probably scroll right past it. For some of you, you haven't even been looking at those numbers. Some of you have at least been looking at the P&L. But the balance sheet is another one of those critical tools in your business that really helps you understand the financial situation of your business and a moment in time snapshot of how much value there is in that business. And what a balance sheet's going to do is it's going to go over your assets, your liabilities, and how much money is owed to the shareholders. But we call it, because you got smaller businesses, we're going to talk about the money that's owed to you as the business owner as part of your owner's equity. And so if you think about it, the balance sheet has to balance. And the way they do that is your assets, everything you own, all the money you have, everything you owe. First thing you have to do is you have to pay it out for any liabilities that you have, any money that you owe. Loans, money that you owe employees, stuff like that. And then what's left over typically will go to you, the business owner. So the way you think about it, if you have $100 in cash and you owe $40 to people, then logically $60 would go to you, the business owner. So your $100 equals the $40 plus the $60, which is another $100. So this $100 matches this $100. And that's why they balance. So let's take a closer look at two different examples of balance sheets, and we're going to dive into them a little bit more so you get a better understanding as to what they are. So with that, let's take a look. Okay, what we're going to do is we're going to take a look at a balance sheet that is just a generic one, just to kind of give you an idea of what you're looking at. As I mentioned earlier, your balance sheet is made up of three core areas. The first one is going to be your assets, which is everything that you own. Basically, any money coming to you, any money that you have, any equipment that you have, anything of value is going to be under assets. Then you're going to have a section of your liabilities, and your liabilities is any money that you owe. It could be a loan. It could be money that you have waiting to be paid out to your employees, to vendors, or anybody like that. We'll go over that a little bit more here in a minute. And then your owner's equity would be any money that is owned to the shareholders, which in your case, it's you, because you are the owner and you are the primary person who has invested interest in your business. If you were a large corporation, you would have actual shareholders, but for most of you, it's just really your owner's equity, which is money that is owed back to you, or how much you can have back. So sometimes you don't get back as much as you think you're going to get back because you just don't have enough for it. So let's take a closer look at each one. So the first section we're going to look at here is the assets. And here are some examples that you could typically find. Cash on hand. A lot of times this might be bank accounts. You might have one bank account, you might have 2 or 3 bank accounts, but whatever it is, it's basically the cash you have on hand from those bank accounts. So let's just say you have one bank account and you've got it connected to your QuickBooks. It will take the money that's sitting in that bank account and put that money in here. Keep in mind, a balance sheet is a snapshot in time because things change from day to day. You might have $40,000 like in this example in the bank account, but tomorrow you might have $38,000, so it would change. Another common area in there is accounts receivable. This is money that's owed to you. So let's say you have some outstanding invoices that haven't been paid yet. You're going to have accounts receivable because this is money that you're supposed to receive that is owed to the business. Prepaid expenses, these might be things that you've paid in advance. For example, insurance is a common one of those kind of items. Inventory that you have on hand, you're going to add up the value of that inventory and it's going to be in here. So those are going to be some of the different current assets. But you also have some fixed assets, which you're probably thinking to yourself, well, why are some of these here and not in another area? they're all going to be lumped together. This is just an example. Your main thing and your main goal is, what are all your assets? So some other examples that we have here is, if you own property, if your business happens to own the building that you work out of, maybe you've owned your shop or something like that, then you're going to have property. Tools and equipment. You're going to go out and you're going to be buying this equipment that you use, or these tools, and they're going to have a value to them. Now, that value isn't always what you paid for it, but what is the value of those items that you have right now? Because you're going to be taking depreciation, and you'll notice here we have a line for depreciation. So if your tools and equipment, originally you paid $10,000 for it, but you've appreciated $3,000, you would capture that here. Some people, I've noticed, they don't have the depreciation line. They just make sure that their tools and equipment is what its current value is at. But typically what's going to happen with a CPA or somebody involved, they're going to use the depreciation piece. For those of you that are using like QuickBooks or something like that, they're probably not going to have that in there. But just so you know, that's how you offset the fact that the equipment's no longer worth the amount of money that you originally purchased it for. Same thing with vehicles, because those also will get depreciated, but if it's an asset to your business. So basically any money, any tools, any equipment, anything of value that you can turn and sell and convert into cash, that's going to be an asset, and that's going to go under the asset category. Now, the next part is going to be your liabilities. Your liabilities is any money that you owe. So let's take a closer look at those. So we have accounts payable of $3,500. That's money that is owed. This is money owed to a vendor, somebody like that. Accrued wages. If you have employees, every day they work, you have to accrue the money that you owe them, because whether it's payday or not, you still owe that money. So you want to make sure you're accruing those wages. Those are wages that are outstanding that still need to be paid. Income tax, money that needs to be paid out. Like, say you still owe some money for your taxes, or maybe you have money that's owed for your state tax that you pay every single month. That would be in here because that is money that is owed. Some other things in here, you might have a mortgage that's outstanding, some credit cards, bank loans, stuff like that. So basically your liabilities are going to be any money that you owe to other individuals or to other businesses and stuff like that. Now, we keep calling this a balance sheet because really sometimes your assets are greater than your liabilities. And if your assets are greater than your liabilities, there's a difference, right? Because they need to balance. So for example, I'm going to drop down here to this category really quick before I go to the third category. It's your assets minus your liabilities and your owner's equity, because they must balance. They must equal zero, which means that these liabilities that you have, any money that's left over from your assets, is really going to be in your owner's equity. So a couple examples. For example, you might have put money into the business at some point, right? You may have started with $500, $5,000, or you put in $1,000 every single month. It's capital that you've put into the business. Plus, you've had retained earnings. You remember, I'm always talking about the fact that you're going to put money towards your taxes, retained into the company, and money that you're going to pay yourself. So each month you were taking money out of the business to go towards the taxes. You've been taking out money for you as an owner, the business owner, and you've been leaving money in your bank account towards your retained earnings. So in which case, what this is telling you is that in this particular example, they've had $128,000 that they've left in the business as retained earnings, but over time, they've also drawn out $84,000, which is going to leave the difference of the 49 in this particular example. So if we take our 44.5 for liabilities and our 49, it equals the same exact 93,500. Now this one's in nice little blocks and everything else, but when you look at a balance sheet from my favorite recommended bookkeeping system for you, QuickBooks is going to make it look a little bit differently. So let me see if I can pull up one of those examples just to kind of give you a different idea. Okay, here is a balance sheet of a business, and what you're going to see is on this particular date for this business, this is what QuickBooks looks like. I've cut off the name of the company, but you're going to see here that the assets, it's going to show their checking accounts, and it's going to say that they've got in total money, cash, remember from earlier, cash, $44,000, right? They've got other money that's out there for 303, so it's showing the $45,000 in the assets that are cash related. And then they have some fixed assets. They've got some depreciation that's in here. They've got furniture. They've got land that they own. They have vehicles. This is the rest of their assets, things that they can sell and make money. So their total assets are $146,000 when you add up everything: the cash on hand, the equipment, all the stuff, the vehicles, everything that they have. Then you're going to move to their liabilities, right? Their liabilities, they don't carry credit card debt for the most part. They've got a little bit because they had to get something done recently, but they pay it off as they go. So you're going to notice very little debt here. They have a little bit of a loan sitting here on the land that they still have. And then they have their payroll liabilities because they have employees and they've got money that they've got to set aside. So you'll see that their current liabilities are pretty low at $38,000 compared to the assets, which were $146,000, which, since it has to balance, that's really going to come up with that difference of $107,000, which is the equity they have in their business and the value that they have. And you'll see here that they've had retained earnings minus what they've taken out of the money. It's worded something different on everything, but it's shareholder distributions, owner's equity, things like that. And then there's still money that's been left over in the business of $91,000 that is also there. And that basically is saying that, let's just say they went and sold this land. They have 101 value basically in that land. Probably can sell it for more, you never know. But minus what they owe, that's going to be a big reason why there's a net income, which is just money that they would make from selling the rest of their assets. So it's just a little example of a different version of a balance sheet. And it's just going to show you a different way of looking at it. All right, badass business owners, now that you know what a balance sheet is, please make sure that you're taking a look at yours. And like I said, if you are not currently utilizing this report, definitely use it. If you already have QuickBooks, it's in your reports section. And if you don't have QuickBooks and you're not using any kind of bookkeeping system, please definitely check out my link below and take a look at QuickBooks. It really is my number one recommended tool because it's really going to help you get your arms around your bookkeeping and really do a great job with that. And if you want to learn even more about your business numbers, you must check out the number one tool that you have to know for your small business so that you can make some money. Check it out over here, and I'll talk to you next time.